So in today's video, we are going to look at a case where an individual is interested in a whole life insurance policy for maximum cash value. They've got a lump sum of money that they'd like to move into a policy quickly. They want to do it in a minimum of 2 years. 1 year was ideal, but that didn't make sense. So we looked at a 2-year funding scenario. So it's a total of about $375,000 moved into a policy over 2 years. But then they had some questions. Specifically, the questions were, can I continue to add money to the policy? And can I add, call it just a minimum amount, and then make some large payments later, perhaps add some windfalls, or if I come into a lump sum of cash, can I throw it into the policy? And the answer is yes. It also depends. So we're going to answer that question and show them exactly what it depends on, and hopefully you find some value out of this video. Let's have some fun looking at some cash value life insurance policies. So what we've got here is a 50-year-old female in this particular case, and what she's looking at regarding the funding, this was step one, was funding a total of $375,000, and we looked at a number of different companies and products, settled on a Mass Mutual 10-pay policy initially, but with that 10-pay policy, what we looked at first was $250,000 going into the policy, and then $125,000 going into the policy in the second year. Now, she might pay more than that in policy year 2, because they've got excess cash on hand that they can move into the policy. But to start, they'd like to see some conservative numbers and also build in flexibility so they can bounce the payments up and down as the years pass. So here, you see the third year onward, 0. Meaning the first option they'd like to see is, what do the numbers look like if they just do that? Then look at some additional scenarios. So beginning with that, if this is you, if you said, okay, I've got 375 grand, I want to move it into a policy, we look at different strategies to get the money in, and this makes the most sense based on what I want to accomplish and the numbers look good. Here's what I would look at in terms of a design. Base premium, we've got at 10%, and that is 10% of the maximum payment. When I say maximum payment, maximum dollar amount going into that policy on any given year, except for catch-up payments, which I'm going to go through exactly what that means at the end of this video. So base premium, 10%. We've got a 10/90 split in the first year. Term rider we have attached is approximately $3,000. A little bit less than that. I'm going to go through the exact dollar amount, but we do have a term rider attached. Purpose of a term insurance rider: cost-effective way to add more death benefit to the policy, which is a cost-effective way to raise the MEC limit while keeping my base premium at a minimum. How do I keep my costs low and plow more money into PUAs, which ultimately accelerate the cash value growth? So the total funding, first year, 250 grand, and then we solved for the minimum death benefit in order to attain a $250,000 MEC limit. Technical stuff. In short, main thing we need to know is premiums minimized, term riders attached to raise the MEC limit, and the PUA rider is maximized. This is how we will maximize the cash value of a policy, especially the guaranteed values. So let's take a look at this design actually. And what we've got here is exactly what we just mentioned. Annual net outlay represents the actual out-of-pocket going into the policy. $250 in the first year, $125 in the second year. Of that $250, here's my premium at 10%. Then we've got this renewable term rider attached, $1.465 million, kind of an oddball number, but there's the cost of it. So if she wants to continue to make payments beyond the second year, she's obligated to what? The minimum base premium and the cost of that renewable term rider. We've got another term rider attached here with LISR, but this is a 1-year term rider. It combines PUA payments and term here. And in a case like this, where I've stuffed the policy in the first year, I can get away with paying 0 into that LISR rider, that PUA/term rider, and then scale payments up again in the future. I'm going to go through that in a little bit. But in this example, what I want to show here, years 1 and 2, what do we see? 250, then 125, total out of pocket, $375K. Net cash value end year. This is your money column. Breaking even just about year 5. Now that's pretty good considering we only paid into it for 2 years. And look at this in year 3. So year 3, annual outlay or annual net outlay, they're the same thing here, is what? 0. So if this is you, that's your actual out of pocket. Here's how much you paid, 0. What this is, annual surrender. This is the base premium of $25,000 plus the term rider cost of $2,871. Add those two together. There we go, $27,871. So that's the premium and the term rider, the expenses that are due, but you're not paying them. The policy is paying for itself in this example through dividends and interest and accumulated cash value. So first, it's covering the premium. Then everything left over is kicked back into cash value. So the net gain in this example, based on the present dividend rate, is just about 10 grand. Same thing the next year, it's still moving forward. That's what I want to see. So we've got that premium due up until year 7 in this example, where we executed a reduced paid up option, which eliminated the premium, cut the term rider, and let the cash value grow at a much faster pace, assuming she doesn't want to make any more payments from this point forward. So this demonstrates exactly what she wanted to see as a starting point, just a 2-pay scenario. Now, we had a what-if question that came up after the fact. And the what-if question was, can I add a lump sum later? And the answer to that question is yes. And you could ask the question the same way as, can I add more money later? The answer is yes, if you continue to make payments. So if I go to that option, that premium offset option there, and pay 0, what I can easily do is resume the minimum premium payment and term rider payments again, no problem. To add money into PUAs, that is sometimes possible. However, insurance companies may or may not require medical underwriting. So how I look at this is when she asks that question, can I add more money later? So if I start with a lump sum, can I add more money? I don't know when, say it's 4 years down the road, policy year 6. Can I do it? Yes, if you cover the minimum premium, then I know we can easily scale payments up again without underwriting and keep everything very, very convenient. Because for the most part, people usually do not want to go through more underwriting after they went through it initially, like we want to avoid that. And if I'm paying at least the minimum premium, then I'm good. I don't have to worry about it. Now, what you can also do, if you wanted 0 out of pocket here, you could exercise an APL, which is an automatic premium loan, or you could take a loan against the policy to cover the premium. The drawback to that is now you've got a loan balance on it, you've got loan interest, but what I've seen some people do is do that for a temporary period of time. Maybe it's 6 months, maybe it's a couple of years. They build up a loan balance, they're aware of what the loan interest is, but then if they pay that loan off at a later date, the policy functions as if they had been making those premium payments, assuming it's a non-direct recognition policy, which in this case it is. So, can I make a lump sum payment later? Yes, but in this case, we do have to pay the minimum premium. So, here's what we looked at here as far as a demonstration. First and second year, that stays the same. You've got a total of $375K that's added to the policy. But we don't want to illustrate an automatic premium loan. We don't want to take the risk of maybe having to go through underwriting, maybe not having to go through underwriting. Like, we want to prevent that if possible. So let's build in convenience here. 3rd through 5th year, have to pay at least the minimum. What's the minimum? Well, about $28,000 in this particular example. $27,871. If we go back to that illustration, I just rounded up to $28,000. But then in year 6, can I make a big payment? Say it's $500,000 if I sell a piece of property, if I receive a deferred comp payout, if I sell a portion of my business, whatever it might be. Can I take a large lump sum of money and throw it into the policy? What was your MEC limit in this policy? $250K. How's the MEC limit work? It is a cumulative number. What that means is if your MEC limit is $250,000, you can pay up to that each year. If in year 2, you pay in $125,000, what that means, your limit was $250,000, you only paid in 125, so you've got, let's put this in purple, another $125,000 of unused mech space. What happens with that is year 3 rolls around, the mech limit is $250,000 again, plus any unused mech space from prior years, 175, so it'd be 375. Now, if I pay only the minimum each year, the unused mech space, meaning if I paid, let's call it $50,000 and had 200 grand of unused mech space, that additional 200 will continue to roll over year to year. So, can I make a big catch-up payment like this? And the answer is yes, based on the mech laws and IRS laws. However, with PUA payments, this is very important to be aware of, because the first time I heard that, I'm like, woohoo, let's throw a bunch of money into the policy because I'm over the first couple years, over the expenses, I can just feed the beast to make this thing look fantastic. However, companies have PUA rules, which we've got a lot of content that goes through specific details on this. But here's the main question. Will the insurance company accept your $500,000 in this case, more than $500,000? Will they accept it? If you were the insurance company, would you accept $500,000? The initial answer that you're probably thinking is, yeah, why would I not take that? Well, here's the thing. PUA stands for what? We think building cash value. Yes, it accelerates the cash value, but the actual term stands for paid up additions. Meaning, when I add money into a whole life insurance policy into the PUA rider, it purchases me additional whole life death benefit that is paid up because I do not have recurring premiums here because PUA payments are optional. So if you were to add $500,000, let's say in policy year 6, into a big PUA payment, what would happen here? Well, the cash value would look fantastic. However, that would buy you additional death benefit. It does depend on your age, health rating and such. But in a case like this, it may buy you another $1.25 million. So remember that question I asked? If you're the insurance company, would you accept that $500,000 PUA payment? Let me ask it in a different way. If you're the insurance company and I want to give you $500,000 deposit toward my PUA rider, but I don't disclose to you that I just got diagnosed with a serious illness and you originally approved me a couple years ago, had ultra preferred, but I wouldn't be approved now. I might die within the next year or so, maybe it's the next 10 years. Would you still be quick to accept that $500,000 from me, knowing that you need to pay out an additional $1.25 if you accept that? Now it's like, all right, let's put the brakes on it. Typically what happens here, what you would say or what insurance companies say is, we'd like to check your health first before we accept that money. Because they want to make sure that someone is not trying to cash in for their beneficiaries, which makes 100% sense. So the question now, after all of that additional context, can I add a lump sum later? And here's how I would really phrase the question if I'm this person. Can I add a lump sum later without underwriting? Meaning, I've got the lump sum, I'm interested in the cash value, can I just throw it into this policy and not have to go through a bunch of inconveniences, medical exams, the company ordering medical records? And the answer is yes, if the policy is set up properly. And from the get-go set up properly. Specifically, what's needed here, all companies have different rules, but generally speaking, if you've got a 1-year term, OYT stands for 1-year term rider attached, then you can just pour the money in. We've done this for years. You'll see the contract language geared toward this with some insurance carriers. How a 1-year term rider works is when you pump money into PUAs, so if you get another $1.25 million in whole life death benefit from that $500,000 PUA payment, how a 1-year term rider works is as your whole life death benefit goes up, your 1-year term rider comes down. So what would happen in this case, we have to have enough term to do this, but we would see a reduction in our 1-year term rider of $1.25 million. And the net death benefit for the insurance company would not change at all. That would remain exactly the same. Meaning if I didn't add that extra 500, or if I did, in year 6, the net death benefit if I die is not going to change. Very easy to follow, right? It took me a long time to repeat this over and over again before I understood it. Let's take a look at a visual here. So first we'll look at an illustration, then we'll lay it out on Excel. So here's that same 10-pay policy. Here's the funding, annual net outlay, years 1 and 2. There's the $375. Then what we did was pay the premium years 3, 4, and 5. And then year 6, check out this. $541,000. I said 540. I'll show you in a second why I ran at 541 because I don't like oddball numbers. But 541 goes in, and this company's illustration software will not allow us to illustrate an amount that would not be accepted if underwriting was required. So we've had people do this over the years without underwriting, no problem. What happens here, its cash value takes a nice healthy jump, right? I'm over $1 million here, but look at this. So before that large PUA payment, your 1-year term rider was what? $910,000. After that large PUA payment, look at that term. Was really bought down, just about all but expired. It's at $68,000. How about the year prior? Dropped by about $8,000 because we're not shoveling much money into PUAs in this particular case. We're paying the base premium plus the term cost, and then the extra $130 is going toward PUAs, right? Toward that 1-year term rider, which is not much. But when we make the huge payment, that big catch-up payment, the insurance carrier accepts it because the net death benefit does not jump by $900K. What this 900 to 68 represents, I'm just going to round here, is that the whole life death benefit in this policy increased by about $900K. But did the net death benefit increase by $900K? No, it increased by $16,000. So why we see the difference there, or why we don't see the difference there, is because it just bought down the term. So for someone who's interested in a high cash value approach and still wants that convenience to be able to add money without underwriting and such, this is really how I like to design it, or one of the options I like to heavily consider, because if I come into a windfall down the road, if I need the flexibility to bounce payments up and down and my health changes or I don't want to go through underwriting, I can do it with this, which is really, really nice. Everyone's situation is different. We don't always use these riders, but I like them for this reason, and they've really helped a lot of people down the road. So let's wrap this up. Why did I use the 541? Because it's an oddball number and I like clean numbers. Here's why. So simplifying everything on Excel as we take a look here. We've got a catch-up payment demonstration. This is the illustration we just looked at. $250 in the first year, $125 in the second year. Total payments, look at this. This will tell you here. Well, first, before I go all the way down, what's your break-even point? Fantastic, between years 4 and 5. But then year 6, 541, and I just wanted to get a clean $1 million into the policy. That's why I did that. So clean $1 million into the policy. I'm at $1,009,000. Don't pay anything into the policy thereafter. I can continue to pay the premium in this particular example. Once that 1-year term rider burns out, I do give up some flexibility. So we do look at the design heavily and see exactly how long I might want to pay into a policy in a case like this. But here's a great example just to illustrate a nice catch-up payment. And the cash value keeps on growing. And maybe it's not 541. Maybe she scales it up to 100 per year and does that for 5 or 6 years. Whatever it might be. So you can make it very flexible. I said 5 or 6. This is a 10-pay. You'd have to stop after 10. Anyway, I'll keep on rambling and talking about this stuff because I like life insurance way too much for someone that sells life insurance. In any event, I hope you enjoyed it. If you did enjoy this video, please let us know. Leave a comment below, hit the like button, subscribe for more. And as always, I hope this helps. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.